Good afternoon, everybody, and welcome to Gray and Gray's McDonald's webinar. Today's subject is year-end tax strategies in an uncertain environment. We'll call it a very uncertain environment. We're very pleased to have so many McDonald's owner-operators and friends from around the country with us today. We appreciate all of you for taking time today for this very important presentation. My name is Mark Keshkagian, and I'm the partner of our McDonald's practice group. On to today's topic. Without further ado, I want to introduce to you Mike Coppell, our senior tax partner here. He's been closely involved with McDonald's tax issues for more than 30 years. Mike understands the tax landscape as well as anybody in the country. More importantly, Mike is adept at translating the complexities of the tax laws into language we can certainly all understand. One technical point before we begin: if you have a question during the presentation, please press the raise your hand button on your screen. We will get to the question either right away or a little later in the presentation, whichever is most appropriate. Mike?
Okay. I'm assuming that everybody can see the screen. And what is important here is the subtitle. We're in a very unusual situation because most times when we have year-end tax planning, we know what to expect in 2012, the current year, and 2013, the next year. This year is unusual. We don't know what's going to happen in 2012, nor do we know what's going to happen in 2013. So there's a tremendous number of unanswered questions. But we're going to do our best to tell you what we know and what we don't know. So, here's my ugly face. My email address is down there on the bottom. Feel free to email me with any questions you may have. You may want to write down this telephone number. My cell phone number is 617-775-2129. And you can feel free to give me a call. I answer the phone. I don't answer late at night, but I answer just about any time, and I'm happy to answer any questions you may have as the year goes on. Now, we are in a highly charged political environment. It is my opinion that as the speaker, I should not voice my political opinions. In your questions or whatever, you can feel free to have whatever political opinions you want, but I don't feel it's appropriate for me to tell you what mine are. So, let's start off. The first thing that we know is that long ago, back in 2001 and 2003, President Bush, along with Congress, in order to avoid a previous economic slowdown, passed a series of tax reforms, tax decreases. And what has now happened is back in 2010, when they were set to expire, President Obama, along with Congress, extended those. Right, and those were extended through 2012. So now what we have is we have a situation where we know what the tax rates are in 2012. They will be the same as they were in 2011. However, we do not know and probably will not know until either after the election at the earliest and very likely after the new Congress is seated in January, what's going to happen in 2013. What may happen is that the ordinary income rate before any surtaxes on the highest end could increase by approximately 10%. The second rate could also increase by approximately 10%. Why is that important to McDonald's owner-operators? You guys know how much you make. I don't have to tell you how much you make. Basically, on average, which is a dangerous number, but on average, an average store generates somewhere around $300,000 to $350,000 of cash flow / profit a year. If that is your income, especially if you have more than one store, which most owner-operators do, I guess the average today is 5.2 or 5.3 stores per owner-operator. What you're going to see is potentially the vast majority of your ordinary income increasing just from the increase in rates by 10%. That's the first issue. Second issue, capital gains. Capital gains rates, if nothing happens, are scheduled to go up from 15% to 20%. And we're going to talk about the surtax on top of that in a few minutes. But right off the bat, we're talking about a 1/3 increase in capital gains. All right. Dividends are even worse. Those of you that have invested in marketable securities, you're receiving dividends. Hopefully, I shouldn't say hopefully you're invested in McDonald's stock. That sounds like I'm a company guy. But if you've been investing in McDonald's stock, McDonald's pays a reasonable dividend. The rate on that dividend is going to go from 15% up to 39.6%. You can figure that out. That's almost 2.5 times if the Bush tax rates aren't extended. We're going to talk about gift and estate in a lot more detail later, but it's very, very important, and some of you may have been at some of the presentations we've done about gifts and estate. We don't have the time to go in depth here, but there's a couple of things you should understand. In 2012, we have the highest exemption, $5,120,000, that we have ever had. And in recent history, the lowest maximum gift and estate tax rate at 35%. If nothing happens, both of those drop to about $1,250,000 of a maximum exemption for gift and estate purposes, with a maximum rate of 55%. Now, just to be fair, President Obama has proposed that there be an estate tax exemption of $3.5 million. However, he has said that the gift tax exemption will only be $1 million. We're going to talk a little bit later why this is important in the McDonald's environment, especially if you're talking about putting your kids into the Next Gen program. I'm not going to get into the details of the Next Gen program. You all know it and understand it, or you can call me or call Mark and we'll walk you through it. But if you are contemplating putting one of your kids or grandkids into the Next Gen program, it is really important that you do this as quickly as possible in order to take advantage of A, lower capital gains rates, and B, the gift tax exemption and lower rates which are now available. All right? Additionally, the big issue that I want to talk about a little bit in the gift area is some of the other things that are scheduled to go away in the Obama presentation. And the most important one is that when you do evaluation for gifting, you're allowed to take certain discounts. Right? You're allowed to take a discount for lack of marketability, because basically you can't market your ownership in a McDonald's restaurant. The company has certain rules and regulations, and to some degree can not necessarily dictate, but can guide you as to who you can sell to. So basically there's a lack of marketability discount. There's also, when we properly set things up, a minority interest discount. So what this can do is it can take the value of a store. So let's suppose you're going to make a gift to your son or daughter, and we value that, and Mark can do the valuation for you. We value that gift at $1 million. Basically what we're going to wind up with is, instead of having a valuation of $1 million of gift, we're going to have something more in the tune of $600,000 or $650,000 because of those discounts. It is very possible that those discounts are going to go away starting in 2013. Once again, if you're talking about doing this, we want to encourage people to talk about making gifts, A, for Next Gen, or B, if you're talking about making gifts to sons, daughters, grandkids, whatever, if you're talking about doing that, taking advantage of what you can do in 2012. And if you have questions about that, we can guide you through that. There's a lot that we can talk about in that area. Now, Long, long ago, last year, basically what happened is that during the Bush administration, in order to make things more fair, there was something put in place where basically your exemption amount and your itemized deduction amount were subject to phase-outs if you earned more than a certain amount of money, which was about $175,000. In 2011 and 2012, those phase-outs went away because they had expired. If nothing happens, those phase-outs come back in 2013, which does nothing but raise your effective tax rate. So once again, this is something that we really have to pay attention to, because one of the things that we're going to see is that if nothing happens, that effective tax rate is just going to climb and climb an inch higher and higher. Now, I'm only going to talk about a few of the expired and expiring tax provisions that have taken effect in 2011 and are going to take effect in 2012. If you email me, I will send you the link to the Joint Tax Committee's listing of all the expired and expiring provisions. I have it here in front of me. It is 30 pages long. All right, so there's a tremendous number of them. I want to highlight a few of them that are going to affect you as owner-operators. First of all, as all of you know, Section 179, immediate expensing of purchased assets, was a $500,000 in 2011. This year, it's cut in half to $250,000. Next year, in 2013, if nothing happens, it drops to $25,000. We don't know what's going to happen to that, whether it will be put back in place, whether we put back in place retroactively for 2012 or not. The other issue in that area is what's called bonus depreciation. One of the things that I hear when I go to McDonald's conferences is that the company tells us that owning a McDonald's restaurant is a capital-intensive environment. The company expects you to continue to make significant improvements and betterments and repairs and maintenance to your stores and restaurants. So it's capital intensive. One of the things bonus depreciation let you do in 2011 and before is take all of the new equipment that you purchased and expense it immediately without having 179. In 2012, that drops to 50%. In 2013, it goes away. Again, we don't know what is going to happen, which does nothing more than complicate the situation as far as a capital-intensive environment. I don't know you guys specifically, but I know a lot of McDonald's owner-operators take advantage of work opportunity tax credits. Basically, it allows you to get a tax credit for hiring certain classes of workers. And there are companies out there that assist you in calculating and determining who qualifies for that. I have bad news for you. Work opportunity tax credits expired at the end of 2011. If nothing happens, they will not be available to you in 2012 or 2013. Those of you that are doing reloads, rebuilds, MRPs, anything along that line, any new stores, if you have one, basically up until this year, you were able to depreciate your real property, your restaurant real property, over 15 years. Starting in 2012, unless there are changes, it's 39 years depreciation. I don't know where you guys are from. If you're up here in the Northeast, with us, you have very high real estate taxes. If you're out where my son and his fiance are in California, you have extremely high state taxes and real estate taxes. what those things normally do to you is they put you in what's called the alternative minimum tax, which is a parallel tax system. And one of the things that if you read the papers or anything else you find out about is that the alternative minimum tax has an exemption amount. And that exemption amount is designed to lessen the effect on middle income taxpayers, whoever that is. What has happened is every year for the last 10 years, we have gone and we have said, wait a minute, alternative minimum tax exemption, when it was created, was not indexed for inflation. So Congress comes in and says, wait a minute, we have to make this fair, we have to index it for inflation. One of the other situations that we have in this country is we have a ballooning deficit. So that basically what has to happen is when we talk about a tax provision which is going to cost tax dollars, we have to weigh that against what it does to the deficit. A one-year fix to the alternative minimum tax costs approximately $70 to $75 billion a year. One of the most expensive things that we're going to talk about. So that basically one of the things that we're going to be looking for as Congress reconvenes after the elections and next year is what are they going to do with the alternative minimum tax? Will they index it? Will they bring these things back? And are they going to pay for it? That's going to be one of the important questions that we're going to see is are they going to reinstate these tax provisions and increase the deficit, or are they going to try and find other revenue-raising procedures in order to do it? Now, some of you also use various tax credits to reduce your alternative minimum tax, specifically the Work Opportunity Credit. One of the things that recently came into place is that Congress passed, and it was agreed to by first President Bush and then President Obama, that they would allow those alternative minimum taxes, those credits, to offset alternative minimum tax in addition to regular tax. Once again, that expired at the end of 2011. So it is possible that even if the Work Opportunity Credit is put back into place retroactively for 2012, if the alternative minimum credits aren't allowed, you're not going to be able to use them. All right. So that's something else that we have to be looking at. You all know about the payroll tax holiday. You all do payrolls. You all know about it. That the first couple thousand, that everybody basically got a $2,000 decrease in their payroll taxes, all right, which was first put in place by Congress and President Bush, President Obama a couple of years ago. That expires at the end of this year again, and once again, we don't know what's going to happen there. It is, again, a very expensive tax provision, and we're going to have to wait and see whether or not it's going to be reinstated for 2013, and if it is, how it's going to be paid for. Now, that's some of the things we don't know. Let's talk about a couple of the things that we do know, and some of the things that we have to plan for because they are going to affect you, owner-operators, immediately. And those are the health care tax increases. And I'm not talking about here, about a month ago, the company presented an outstanding presentation to all the owner-operators talking about the employer mandate and how much it was going to cost you per store and how it was going to be calculated. If you have any questions about that, I know you can call Dan you can call Dan. We are preparing a template to assist you in calculating how much that's going to cost. If you have questions, you can feel free to give me a call. We're conversing in with the employer mandate, all right? But that's not what I want to talk about. What I want to talk about is that the health care tax law is the largest tax change to individuals in the last 20 years. Okay? It will affect high-income individuals. Now, if we go back again and we say that Again, an average owner-operator has income of approximately, again, these are all averages for whatever they're worth, of approximately $300,000 or $350,000 per store. And an average owner-operator has 5 stores. So an average owner-operator is going to earn something a little north of $1 million a year before any itemized deductions or other deductions. High-income people are single individuals with adjusted gross income of $200,000 a year, and married filing joint average adjusted gross income of $250,000 a year. If you want to know what your adjusted gross income is, take out your tax return. All you need is the first page. Go to the first page, look at the bottom right. That's your adjusted gross income. There's minor changes that could take place, but for all practical purposes, that is your adjusted gross income. And if it exceeds those amounts, you have to pay attention to what we're going to talk about, because we're talking about potential significant increases in your income taxes. The first item is an additional tax, additional Medicare tax of 0.9%. It is scheduled to raise just under $87 billion over 10 years. Okay? Now, I don't know how many of you out there are S-corps and how many of you out there are partnerships. I'm assuming that nobody out there is a C corporation. I don't know of any. Are there any, Mark?
Yeah, maybe a few, but not many.
All right. You're either a partnership or you're an S corporation. Let's talk about S corporations first. If you're an S corporation, you get 2 types of income. You have wages, right, you get on your W-2, and you have an income distribution based upon how much is distributed to you as income on your K-1 other than wages. If you are active in your business, and if you're an owner-operator, you're by definition active in your business, the income distribution will not be subject to that 0.9%. Let me repeat that. If you're active in your business, your income distribution will not be subject to the 0.9%. So what does this mean? This means that you have to be looking, and you should start looking at it in 2012, and you should be planning in 2012 for how much you're going to want as wages in later years, and start modifying the wages amount now so that you're minimizing those wages to eliminate or reduce the 0.9% additional tax, as opposed to income distributions that may or may not affect you depending upon whether you're active or passive. Okay? But remember, if you have wages, it is going to, that 0.9% is going to be there. If you're a partnership or a limited liability company, taxed as a partnership, you have something similar. What you have is you have guaranteed payments, or majority of you, almost all of you have guaranteed payments, right, which is a payment that is made to you and you're guaranteed to get it, and you have earned income. The same rules are going to apply for you as apply to wages. But what we want to make sure in this case is that what you've done is bifurcate your ownership, assuming that there's more than one owner, that you have an owner along with your wife or spouse or significant other or whomever. And what we're doing is we're making multiple layers of ownership, so that basically what you have is you have a managing member, which you will be you, which is usually a 1% managing member. You will receive a guaranteed payment, which will be subject to the 0.9%. You will have 1% of whatever is left in your income as earned income, which will be subject to the 0.9%. All the other income of your operation will avoid the 0.9%. So once again, we want to make sure that we are planning this appropriately. All right? Now, one of the other things I want you to make sure of, and this is not something I expect you to understand, but I want to make sure that you are talking to your tax preparer to make sure that they are properly classifying all of the owners of S Corp stock or partnership interest are properly classified as active or passive. All right? I'm not going to get into what those terms mean, highly technical, and if you want to give me a call, I'll be happy to explain it and explain the 7 ways you can do it and all the rest of that, but it is important to understand it, because if you are active, you can be avoiding the 0.9% and later the 3.8%. If you are passive, you're going to have to pay the 0.9% or the 3.8% that we're going to talk about in a little while. So this is very, very important that you go out and make sure you understand this. Why plan now? One of the things that we have learned in discussions with the Internal Revenue Service and the Department of Labor and Treasury is that they are always looking for trends. They're looking for trends of your wages, trends of your guaranteed payments, and so on. We want to make sure that everybody is taking care of that in 2012 in starting the trends the way we want them to be and the way you want them to be in order to minimize these new additional taxes caused by the health care law. All right? Now, I don't want to overemphasize this, but please, please, please talk to your tax preparers. Make sure that active and passive are done properly. I will tell you that recently I reviewed a tax return for an owner-operator who was not a client of ours, and basically what they had done is they had said that the spouse, the non-owner-operator, was being treated as passive. If that was the case, all of that income would be subject to the 0.9%, which is wrong. A spouse, by definition, has the same active or passive as their owner-operator spouse. And that is something that, once again, you should be looking at. Talk to your tax preparer. Give me a call, and I'll be happy to talk to you about it. Now, if you think 0.9% was bad, we now have a 3.8% additional tax on net investment income. This gets a little complicated. Net investment income includes interest, all your bank interest, dividends on your McDonald's stock and all other marketable securities. If you own rent, if you own buildings and receive net rental income, on your rental income, royalties, if you should have any, and annuities, if you should have any. All of those, if you exceed the $200,000 or $250,000 of adjusted gross income, are subject to an additional 3.8% tax. Now, I copied this directly from the Joint Tax Committee's explanation of the law. So I want to read it because it says, net gain from the sale of property other than property held in a trade or business that is not passive. Notice the word passive again. All right? So the first thing you have to do is make sure that you are properly treating active and passive. The second thing that this says, and this is an interpretation that I believe in, and in discussions with other people, I serve on the AICPA's committee that is working with Treasury and the IRS to review the regulations they're going to be putting out on this. What this says is that if you sell your business, if you sell a store, that is gain from property that is used in a trade or business, and therefore that gain is not subject to 3.8%. There's a tremendous amount of misinformation about this. All right? So I think it's important that we understand that if you are selling your business and you are active in the business, you will not be subject to the additional 3.8%. I've had several owner-operators call me and tell me that they want to sell their stores before the end of the year in order to avoid this tax. That is not true. All right? As long as you're active in the business, it is not going to happen to you. Okay? Now, other income derived from any trade or business which for which the tax doesn't apply is therefore going to be subject to the 3.8%. Now, there's something else I want to talk about here. Now, I know there are no bankers on the phone, so we can talk as far as we want to. Let's suppose, just for simplicity, that you have $1 million somewhere that you have invested that is giving you interest or dividends, and it's in yours or your wife's name, your spouse's name. So what's going to happen is that the interest and dividends on that $1 million is going to be subject to an additional tax of 3.8%. However, if that $1 million is put into the trade or business, your stores, then it will not be subject to the 3.8% because we can demonstrate, because the company has clearly demonstrated to us over and over again that a McDonald's store is a capital-intensive business. You need the money in order to invest in current and future things for your business, and therefore we can avoid the 3.8% if you put the money into your operating entity, not outside it. Yes, I understand the risks, but from a tax point of view, it is beneficial. And we can talk about how we do that and everything else. Give me a call, give Mark a call, and we can talk about how that works. You really have to sit down and start planning these things. All right. Now, there's one other thing that I was talking to a business owner yesterday afternoon, and there's one other thing that I want to make sure, and we'll talk about it when we talk about capital gain harvesting. There's something called wash sales. There's another misconception about wash sales. A wash sale only applies if you have a loss. If you take your McDonald's stock, for example, and you sell it today for a gain, you can buy it back tomorrow. Right? And basically you'll have to report that gain, but because you did that, you'll now have the new basis of what you buy it for, and you'll avoid the 3.8% tax. We'll talk about that a little more when we talk about capital gains harvesting. Like now. You are going to hear, unless you already haven't, the term capital gain harvesting. Many financial advisors are suggesting to their clients that they do exactly what I just said. They should be selling their assets which have a capital gain this year, 2012, in order to avoid that additional 3.8% tax. And that's called capital gain harvesting. It's a new term. We used to have capital loss harvesting, which basically meant we were selling stocks that had losses in order to offset gains. In this situation, what financial advisors are telling their clients is no, you should be selling your capital gains assets in order to minimize that 3.8% tax. Again, this is something that very, very much depends on your individual set of facts and circumstances. It is something you should talk about with your tax preparers and your financial advisors. It is very, very important that you discuss this. 3.8% is a significant amount of money. That is especially true if the Bush tax rates on capital gains increases from 15% to 20%. What we would now have is we would now have a capital gains rate of 23.8% instead of 15%, which basically means that your capital gains rate just increased by more than 50%. So that's why people are talking about capital gain harvesting. And it is something that very, very much you're going to hear a lot more about from financial professionals over the next few months. Roth IRA conversions. Remember what I said, that what we're talking about is, does your adjusted gross income, the number on the bottom of page 1, exceed the $200,000 or the $250,000? One of the things that is going to be included in that $200,000 or $250,000 is any distributions that are made out of your IRA. One of the advantages of a Roth IRA as opposed to a traditional IRA is that a Roth IRA has no required minimum distributions. You never have to take a distribution out of your IRA. So that basically, if you have a very significant IRA and you're at a time in life where you think you're going to have to start taking money out of the IRA because of required distributions, it is something to consider. It is not something to go into blindly. You have to pay the taxes up front in the year that you do it. But it is something that you should discuss with your financial advisor if you have a significant IRA. Investment choices. Once again, there's a tremendous amount of discussion going on as to that people should be changing their investment portfolio. They should be making more investments into municipal bonds, which are tax-free and therefore avoid the entire 3.8%. Once again, you have to sit down with your financial advisor, sit down with your tax advisor, and see what makes sense to you. There's a lot going on here, and it's really something that you have to take a long, hard look at. Okay. Now, how do you determine how much is net investment income? And this gets pretty simple. It is the lesser of the undistributed investment income or the amount over the tax bracket. So, for example, let's suppose that you have $280,000 and you're married. You have $280,000 of adjusted gross income, and $50,000 of that is from interest and dividends. Basically, in that situation, you're going to have $30,000 that is going to have the additional 3.8% tax on it because that's the amount in excess of $250,000. Okay? And again, this is something that if you are in this situation, if you have significant investment income, you should be sitting down and you should be talking to your tax advisor sooner not later, or your financial advisor, as to what you should be doing and how much this is going to cost you. The big caveat here is we don't know what's going to happen to the Bush tax rates. We don't know what's going to happen to the capital gains rate. We don't know what's going to happen to the top ordinary income rate. We don't know what's going to happen to the dividend rate. It is distinctly possible. Those of you that are on our email list know that we sent out an email in the last couple of days that said, basically, we've already been told that the discussion about what's going to happen to all of these tax items isn't even going to be discussed in Congress until after the elections. Therefore, it is distinctly possible that not only won't we know about it after the elections, we may not know what's going to happen in all these situations until sometime in 2013, and it's effective retroactively. Right? So it's very important that you sit down with your advisors and see what the possible effect of this is going to be and what risk you are willing to take. I want to go back to gifting. It is important to talk about gifting for a number of reasons. First of all, once again, I can't emphasize the importance of, if you are considering next gen, of doing it now while you can take advantage of the $5 million exemption and the discounting and some of the other techniques that are available which may not be available after this year. The second thing that is that with the exception of 5 states, you also have to remember that gifting and estate are treated differently. In all but 5 states, there is no tax on gifts. there is a tax on estate and inheritance. So if you make a gift and you take that gift tax exemption, it is going to affect the amount of eventual federal estate tax you're going to pay. But almost every state has an estate tax. So here in Massachusetts, for example, if you have an estate of over $10 million, you're going to have, in addition to your federal estate tax, you're going to have a 16% state tax. So basically, we have to look here and say that, does it make sense to wait for the gifts, or does it make sense to do the gifting now? In my view, assuming that you can afford it, and understand, I'm 65, and I'm sitting here, and my wife and I want to make sure that we have sufficient assets to last us for the next, 25 or 30 years. If we do, does it make sense for us to make gifts to our son and his fiancée, our daughter and her husband, in order to minimize the possible eventual estate tax, because there is, once again, we're taking advantage of no gifting tax. Right? That is something that you really have to sit down and work through and figure out, can you afford to make those gifts? And understand, I am a firm believer, very firm believer, that you must make sure that you have sufficient assets on your own, that you not rely upon your children to take care of you in your old age. There's my lame duck. We know that nothing is going to happen until the lame duck session at the earliest. We're going to be keeping track of what happens. What happens during the lame duck session, a great deal is going to matter what happens to all three elections. Yes, there are three elections. There is the election for president. There is an election for who controls the Senate. And there is an election for who controls the House. Three elections. What happens in all three of those elections is going to determine what happens in the tax area, either in the lame duck session after the election and before the installation of the president and new senators or congressmen in January, or whether that's going to happen after the lame duck session when the new president and new congressmen and senators come into play. We're not going to know that for another few months. Please be aware, you don't have to rush into things. At this point in time, you should be sitting down with your tax advisor, sitting down with your financial advisor, saying, okay, what is my exposure? What is my worst possible exposure if, for example, all of a sudden I'm sitting with a 23.8% capital gains rate? What is my exposure if I'm sitting there on a dividend rate of approximately 44%? What is my exposure? You should be sitting there and saying, what is my exposure? And depending on what happens, what do I want to do? All right? That's what we're talking to people. That's what I'm talking to clients about. I'll be happy to talk to anybody. You have my cell phone number. You have my email address. Give me a call, and I'll be happy to talk to you. But talk to your professionals. Don't wait until December. Talk to them now so that you truly do understand it's very complicated. What are the possible ramifications? Now, if you have significant medical expenses, and I hope and pray that you do not, I wish for you the blessing of health, for you and yours. However, for those of you that have not yet reached the golden age of 65, starting in 2013, if you have medical expenses that you think are going to be deductible, there is a threshold that you have to exceed in order for those medical expenses to be deductible. If you are under 65, that threshold in 2013 is going to increase from 7.5% to 10%. Again, I bring this up only from a planning point of view. If you are in the situation where you have significant medical expenses for whatever reason, you should make sure that you try and front load those medical expenses into 2012 where there is the lower threshold. Okay? If anybody out there is a C corporation or has investments in C corporations, this gets kind of technical, but there is something in C corporations. The C corporation is a regular corporation. And in regular corporations, there's something that's called earnings and profits. For simplicity's sake, we can say that your earnings and profits is kind of like the retained earnings of a regular corporation. Once again, we want to talk about, if you're in that situation, do we want to distribute those earnings and profits as a dividend in 2012 at 15%, as opposed in 2013 where we may have to be distributing dividends at 44%, 43%. Once again, I don't know if this applies to any of you, but it is something that you should absolutely be looking at if you are a regular corporation or involved in a regular corporation. I don't want to spend a lot of time on repair regulations. However, if you have a reload, a rebuild, an MRP, or a new store, a brand new store, all right, you should be talking to your tax professionals regarding special cost segregation studies for your repair regulations. You should also be talking to them based upon the new de minimis rules as to the threshold of what you can expense and as called materials and supplies. I know a lot of you, a lot of our clients, sit there and say anything under $1,000, we don't want to bother with it. We're just going to expense it regardless what it is. That no longer works based upon the new repair regulations that came into place January 1st of this year. I will tell you that the IRS has indicated that they're not going to strictly enforce these regulations immediately. However, you should make sure that you're aware what's out there. Right? They're extremely complicated. If you want, we have on our website a webcast that we previously did, which I think is out there, Mark?
Yes.
It is out there. It is on our website, and you can listen to a webcast that has been recorded that talks about the repair regs and what you can and cannot do out there with them.
And we'll be updating that in the first quarter of 2013.
At the latest.
Right.
All right. Now, I have a saying, and this is very strange coming from a tax professional. However, as a businessman talking to business people, never let the tax tail wag the economic dog. You should not be doing something for tax purposes if it is going to significantly have a bad economic effect. That's why you have to talk to your tax professionals, you have to talk to your financial professionals, and really take a long, hard look, which is why, especially with the uncertainty we have, it is important to talk to these people earlier rather than later. That's a picture of me, ugly and all. My cell phone number is on there. My direct office number is on there. My email is on there. Feel free to contact me with any questions you may have. If you have any questions, you can type them in or you can just ask them. Anybody? Okay. Go ahead, Mark.
Okay, on behalf of Mike and myself and Greg, again, thank you very much for tuning into our webinar today. As you know, we do these every month. Very specific topics relating to you and your business. Just tune into our website. You'll get more information on next month's webinar. And again, if there are no questions, we appreciate you tuning in and look forward to seeing you back here in a month. Have a great rest of the day.